Morning, everyone. Welcome to the first seminar of the year. Our speaker today is Stuart Theobald. He's the chairman of Intellidex, a research and consulting house, specializing in capital markets and financial services. He works with leaders in banks, organized business, development agencies, philanthropic foundations, regulators, and governments to develop strategy and market insight. And he'll be presenting on some work jointly done with some of our colleagues from the South and Central. Welcome, Stuart.
Thanks very much. And thank you for the introduction. You'll see that Intellidex is not there because we changed our name about 4 months ago, and we're now Krutham, thanks to some lawyers who can write strongly worded letters about what they claim to be their trademarks. So thanks very much for inviting me. We've been on a journey of a few years with this research. It's nice to be able to talk to you about it. It's nice especially to be able to talk to some of you in person, in the flesh, in real life, which was the first time in this project that we've been able to do so, because it was born in the midst of COVID and has been conducted virtually. But that also reflects that people involved have been all over the world. So I'm going to talk to you really about two different aspects on a question, which is the relationship between inequality and financial markets, and how a disclosure regime about inequality might affect that relationship. And the two aspects I want to think about is the effects of inequality on market returns, and secondly, what the effects of a disclosure regime might be on financial markets. Let me say up front that it won't surprise you that we take as a premise that market returns are the objective of most market participants. And if you're going to frame an intervention on those markets, it is best to analyze and understand that intervention and its effects in terms of those returns, if you're aiming to drive behavioral changes. So we'll talk a bit about what disclosure can do and what kinds of behavioral changes might be possible. So the first question is, should investors care about inequality? And I think that there are different views that aggregate into, I think, a positive answer that investors should care about inequality. But it's not a slam dunk. There is a great many things that investors care about, or at least consider relevant to maximizing returns. And inequality has to compete for space among many other objectives. But when it comes to how inequality affects financial markets, there are several different arguments, and we picked a few that are probably the most discussed in the literature. So one is the social and political instability that arises from inequality. So investors depend very much on having a fairly high, reliable view on future returns. Fundamentally, the value of any financial asset is the present value of future cash flows. And if those future cash flows are hard to predict, the present value of that asset declines. So we have a lot of trouble explaining this to government, that if you say something like, we are just going to consider a policy change, we're not saying we're going to do it. We say, well, you're immediately increasing the discount rate that investors must apply to future cash flows from any South African investment, and you're thereby depreciating the present value of all financial assets in South Africa. So we try and discourage saying things like, we are going to possibly change things in the future, because it just encourages a perception of instability. And inequality is linked to political and social instability of that sort, and therefore can damage the present value of asset values. There is a political power inequality perspective that when political power is very vastly unevenly distributed, you have much greater risk of instability, but also an inability to influence political outcomes in a way that would be favorable to financial markets. Then there's the financial crises channel. So this particularly became prominent after the global financial crisis. And Stiglitz argued that one of the features that perpetuates and worsens the consequence of financial crises is that when you have high inequality, you have very low resilience to crisis in a big portion of the population. So if you have very uneven distribution of wealth, a population is much more vulnerable to crisis. They're unable to resist it, and that exacerbates the duration of financial crises. There are various ways in which income inequality is perceived to hinder economic growth. It encourages redistributive political action, high taxes on the most profitable parts of the economy, for example, and that can be negative for investors. Creates uncertainty on the security of property rights, reduces the accumulation of human capital. So we, in the highly unequal societies, relatively few in the population are able to develop their skills and human capital, and weakens the credit market. You have a much smaller portion of the population that's able to access credit and drive financial returns. So on the surface, investors should have an interest in avoiding these kinds of consequences. But what would the counter argument be? If investors would say inequality is in some sense positive for investor returns, what might they say? Well, I mean, there's some very dated positions that I don't think today people really take that seriously. So there's a kind of Friedmanite idea that inequality encourages work and productivity, and that redistribution discourages it. So overall, an economy grows more slowly if you are redistributing. There is the idea from Keynes that you need concentrations of wealth to be able to achieve certain kinds of economic investment. So if you don't have concentrations of wealth in certain hands, they're unable to make large-scale investments that can achieve step change economic growth. So you kind of want some degree of concentration. There's also an idea that extreme inequality can actually be positive for market stability, because in economies where nobody but a small elite has political power, that small elite is able to maintain stability in a way that somewhat more equal society would not be able to. So if you just imagine if you were to graph the risks of social instability, it's probably highest with a high level of inequality, but as you get to extreme inequality, actually social stability can be locked in if you have a sort of strong dictatorship type of model at one extreme. So these are maybe some ideas where investors will say, well, some inequality might be helpful, but I don't think that there is anybody but some odd outliers who take these arguments very seriously. So I think we can reasonably safely say that investors agree that inequality is bad and they have an interest in lessening it. So if we think we now like to think of investment motivations as ranging on a continuum of finance first to social first. So social first investors are, for instance, philanthropies who will make donations or impact investments to achieve social outcomes. Finance first would be, hedge funds who absolutely are determined to maximize returns. So a finance first position would say we don't like inequality because it causes weaker returns, and a social first position will act against inequality as it causes negative social outcomes of injustice. And most investors will fall somewhere on that continuum, but they all have an interest in reducing inequality. But then it comes on to the second question, which is disclosure the right tool for investors to be able to deliver the desirable outcome of reducing inequality. So let's talk a bit about disclosure itself and the economics of it. Disclosure requirements have grown dramatically in the last 3 decades. They usually are driven by crises. So the dot-com bubble in 2000 was a very important crisis in terms of the effects it had on disclosure, because suddenly investors had to start disclosing what they were doing, what they were invested in. Investment banks had to disclose their conflicts of interest. All kinds of additional requirements were imposed. The global financial crisis has driven a whole new raft of disclosure requirements. And historically, these have been driven by financial disclosures. So we now have the International Financial Reporting Standards. IFRS followed the International Accounting Standards. And this is attempting to establish global norms of accounting disclosure rules. The United States, most famously, refuses to apply IFRS. It has its own generally accepted accounting principles, but most other countries in the world now comply with IFRS, and it is a global standard. And it is an incredibly detailed disclosure framework with rules for everything that is required to be disclosed. There are IFRS standards. I can't remember how many there are, but it's a vast plethora. And this keeps many accountants very gainfully employed as they try and help companies comply. So these appear to be obviously in investors' interests, in limiting scope for fraud, in information asymmetries, in enabling investors to forecast earnings and to make decisions about what to invest in. But I think there is still recognition that there is some degree of balance of costs versus benefits that disclosure regimes require. Costs, you've got to pay these armies of accountants to do the work, and there needs to be a benefit from that disclosure to justify that cost. And I think there is a pendulum that swings around this, depending on the latest crisis and how salient an information asymmetry happens to be at a particular point, and whether investors are willing to pay for the costs of increased disclosure. Non-financial disclosure requirements have become much more important, probably since the financial crisis in particular. And this is another area where you can detect a pendulum swinging on where the cost-benefit analysis falls. So ESG, environment, social governance, has been the most prominent of the non-financial disclosure approaches that we've seen growing. ESG is a contested concept. It is remarkable that in one room of people who all think they're talking about ESG, the difference of opinion can range from those who believe we're having a conversation about the positive good that companies can do in our society, through to those who believe that all we want to know is the environmental and social threats to this business so that we can decide to sell or buy the business. And those, I think, deeply incompatible views have historically been united under this ESG concept. And what we've seen happen over the last year and a half, particularly driven by the American culture wars, who have somehow embraced ESG as part of, as a touchstone in that cultural war, is a dumbing down, or at least a reduction to a lowest common denominator concept of ESG, which has become a value concept rather than a values concept. So it is now, ESG is about the value of an environmental or social risk to a company. And this has very real consequences that I don't think are appreciated for those who want to have disclosure standards to affect social and environmental impact of companies. ESG as it has becoming through the International Sustainability Standards Board that has been incorporated under IFRS. So this has been, we had many different frameworks and standards across global markets emerging. The task force on climate financial disclosures was perhaps the most successful in getting companies and investors to disclose their carbon emission profile of their investments. But there are many other, and it depends on the industry. In banking, there are a dozen different frameworks that banks can comply with. And so these are being consolidated into, well, there's a process of consolidation into the International Sustainability Standards Board. TCFD has been consolidated into that. And a lowest common denominator has set in, where it is agreed in order to get this consensus that we are focused on materiality. And if you read the 2 sustainability disclosure standards of the ISSB, everything is framed in terms of enterprise value. So what are you disclosing? You're disclosing things that affect the enterprise value of the company. You are not disclosing things that affect social and environmental outcomes. And I don't think it's been appreciated that this has perverse outcomes. So, for example, if I'm concerned about environmental and social risks to the enterprise value of my business, I need to do a cost-benefit calculation of whether we introduce a carbon mitigation investment or not. And my conclusion might be, from a pure enterprise value perspective, that we're better off pumping carbon dioxide into the air than we are in investing in reduction. And that would be an ESG disclosure. We are better off pumping carbon into the air, right? Obviously, there are not going to be many of those, because I think genuinely you're probably better off not pumping carbon into the air from an enterprise value perspective, but that's not necessarily the case. I was speaking to a fund manager in California and talking to him about how they apply their ESG fund strategy. Now, California, you think, is a nice kind of green progressive state. He says, well, our ESG strategy, I'll give you an example. We analyze all of our investments for the environmental and social risks that they present. We concluded with one investment we had, which was involved in fossil fuel extraction, that they were vulnerable to an emissions regulation that the Californian state government was going to introduce. And this regulation would cost them a great deal of money. So we disinvested, we sold. So I said, okay, so you sold because the company was going to reduce its emissions. He said, yes. I said, and that was the fruits of your ESG strategy. Yes, very, very pleased with this. And I said, so what did you do with the proceeds from the disposal? And he said, well, we went to Texas and we bought a similar company because there's no risk of disclosure restrictions or emission restrictions in Texas. So this strikes me as kind of perverse to what most of us think we're doing when we talk about ESG in financial markets. But it is the future, right? We are on our way firmly towards a single materiality concept of environmental and social disclosure standards. And it's leaving a big gap for what we used to think we were talking about, which is an impact perspective of corporate investment behavior. When we talk about inequality disclosure, we're kind of thinking of an impact, right? We want this good social outcome, which is that companies and investors are incentivized to reduce inequality. But the way the world is going, we are having a conversation only about what the impact on the value of the company is, the value of the investment. And that's tricky. So when it comes to disclosures and negative effects that have a cost on companies, there's a few that we're starting to see and starting to talk about. One of the disclosures that has really accelerated since the dot-com bubble is disclosure of earnings. What do the people who run this company make, right? So now you can pick up the annual reports of any JSE listed company and see what all the directors are paid. Lovely. So the head of a bank makes 30, 40 million. You think, gosh, that's a bit gross. But there's evidence emerging that this disclosure behavior is actually forcing salaries higher. You might have thought they'd be a bit embarrassed, right? But that's not what happened. what happens actually is the CEO gets in front of the remuneration committee of the board and says, have you seen the guy at ABSA made 20% more than I did? This is just not fair. And the board caves, gives him a 30% increase. And then the guy at ABSA goes, have you seen the guy at Salah Bank made 10% more than me? And we've triggered this kind of race to the top. And honestly, I kind of wonder, have we made life worse for ourselves when we thought we were going to be embarrassing these institutions into paying less? We've done the opposite. There are other costs, which is enabling competitors. So when you disclose these things, and many disclosures actually give really useful information to your competitors, telling competitors where your most profitable parts of the business are and so on, and that has an indirect cost. And that's one of the main costs that makes companies not want to be listed on the JSE, right? Because you have then got this huge disclosure requirement, and all of your competitors know everything about you. And that comes with a loss of competitive positioning. And there is just a general problem with listing environments to flag, which is that most of these disclosure requirements apply to listed companies specifically. It's much easier to force disclosure requirements on listed companies because you have the stick of being listed and therefore having public shareholders, and you therefore have a legitimate claim to say that disclosure is important because of these shareholders and the fact that they're public. Whereas an unlisted company, those arguments don't hold. Why would you force them to disclose, even though you want to as a social benefit to the sunlight, sanitizing sunlight of disclosure, but you can't frame that in terms of investor disclosure need. But certain kinds of disclosure clearly work. So one area that has grown in the last few years internationally is gender pay gap disclosures. You see this in the UK because one of the gender pay gap disclosures that has really captured the public information is the BBC's presenters. So the BBC is required to publish figures on its best paid people. So it has presenters who make millions of pounds a year, and then they're rather embarrassed when Gary Lineker makes like 3 times their most popular female presenter. And this has actually caused a dramatic change in the way the BBC pays its male versus female employees. But so the positives have been an increase in the number of women being hired. There's been an increase in the number of women being promoted. But interestingly, it has lowered companies' overall wage bills. And it's really because the growth in male components of the wage bills has slowed down relative to female. So you're achieving improved gender pay gap outcomes, but it's really by paying the men less than it is by paying the women more. I mean, not quite. Women are still getting paid more, but overall the wage bill has shrunk. And there does seem to be a productivity decline in firms reporting pay gaps, but that productivity decline is smaller than the decline in wage bills. So overall, the firm is better off. Wage inequality has obviously been a recent disclosure focus point. And in South Africa, of course, we've had this debate in respect to the Companies Act. And the different options. Do you compare the CEO versus the worst paid worker, the CEO versus the median worker, which is what happens in the UK, a kind of Gini coefficient of top 10 versus bottom 10 or top 5 versus bottom 5. And the UK now has a few years of history of these publishing these pay gaps. So in the UK, it's the CEO versus the median employee. And you can see, this is now 2 years ago, if you look at the top 10 there with the worst ratios, so you have Ocado, which is an online groceries thing, JD Sports, which is a sports apparel retailer, Tesco, which is a big supermarket. So you can see retail really dominates there. And if you look at it by industry sector, where the lowest ratios are. You can see that interestingly, financial services is one of the lowest paid ratios, technology one of the lowest, and the worst off is retail by quite a big margin. Healthcare not really either, travel and leisure, banks, interestingly, although most. And I think that's an interesting outcome, and it does drive certain kinds of behaviors. But a key question for us in the global south is, what is the relationship between wage inequality, so call it internal inequality within the firm, and inequality in society, so call it external inequality. And if we think about South Africa, one of the main drivers is the informality of the economy, and you have a formal sector and an informal sector, and inequality tends to feature a formal versus informal sector distinction between the employed and the unemployed, and with unemployment concentrated in unskilled youth. So it seems that in countries with very low unemployment, the US, the UK, if you drive internal inequality in a firm, if you drive that down, it should have a macro consequence of reducing inequality overall, because so many people are employed. If you're dealing with internal inequality, you end up dealing with external inequality overall. But there could be a conflict in incentives in different markets. So one of the behavioral responses, if you're trying to reduce internal inequality in a firm, is that you accelerate capital intensivity, right? You reduce employment of unskilled workers and bring in machines. You outsource low-paid jobs, you outsource cleaning, etc. So if that's the case, where there is high unemployment, you're discouraging the employment of low-skilled, low-paid workers by enforcing a wage inequality perspective, which can have a negative impact on external inequality, even while internal equality improves in the firm. So there is outside in risk dominating inside out risk, right? So behavior of the firm inside and the impact on the out, and the behavior versus inequality internally. So if you think about that positioning, and I think a South African perspective in an international debate about how to do inequality disclosure is quite important, because we are kind of unique in the size of our unemployment and the gap between the formal and informal sectors. So what does that mean also from an investor perspective? If you think about how firms are prejudiced by loss of competitive positioning through disclosure, firms may also be prejudiced in the loss of bargaining power if they're disclosing details on wage internally, and loss of bargaining power if their competitors are disclosing details of wage. And if investors are prejudiced by that kind of disclosure, is it in their interest to achieve the disclosure without their support? And I think you can always impose disclosure requirements on companies without investor support, but it's much harder and much more expensive, and potentially discourages investment, which discourages growth. If we're concerned about external inequality, and I think this is where, as we were working on this, there's a kind of different perspective with our US colleagues who worked with us on this paper. It's not salient to them that you can have this unemployment informality feature in your economy. So they just don't really think about it. They don't really think about how a firm's behavior can affect external inequality. If unemployment is high, labor-intensive firms are better for inequality than capital-intensive firms, right? That's not true if unemployment is very low, because capital intensivity improves productivity, improves the rand of economic output per unit of labor. So you should be able to improve wage levels with capital intensivity. But in high unemployment environments, that's not true. Capital intensivity will worsen inequality. And then there's a question of what the firm does in the market. A firm that sells products and services that lead to financial inclusion of excluded marginal workers can be very positive in its impact on inequality through what it does. Low-cost skills development, for example, some of our sort of low-cost private schooling businesses, people who develop apps that allow small-scale farmers to access markets and to see market prices for signals and what to plant. Those can have quite important improvements in the bottom of the pyramid earnings levels and reduce inequality. So if we wanted a disclosure regime, we'd probably want to try and understand the effects of firms on inequality overall. And how would we measure that? Now, one of the things which I haven't included in this presentation that we looked at is BEE regulation, because black empowerment frameworks are actually one of the few examples in the world where external inequality is the point of the framework, right? You're forcing firm behavior to try and improve overall transformation in the society. And in order to do that, we have this complex scorecard approach where you measure lots of different aspects of how firm behavior affects racial inequality and in transforming firms and the economy. And we have the cascading mechanism of procurement. So I am incentivized to buy from firms that score higher on BE scorecards, which incentivizes them to buy from firms, and the cascading effect across the economy works. So BE actually is a framework that does, to some extent, address external inequality that we thought it's worth the world looking at when we think about how we deal with inequality overall. And that is what I had to tell you. So let me sum up. From a disclosure point of view, we do have to really think about what investors' interests are, where they'd see the cost-benefit analysis of disclosures around inequality. What is it that will support their decision-making? We think on balance, investors do have a positive incentive to act so as to reduce inequality, because inequality does reduce financial market returns. But we think it's very hard to determine what that disclosure should be. Wage inequality disclosures don't seem to affect firms in the right way if our ambition is to deal with external inequality. And in countries where there is high unemployment, external inequality is more important than internal inequality. Internal inequality and very low unemployment will drive macro inequality in a country, but that is not true. The opposite might be true in a country like South Africa. If you think about those wage ratio graphs, if we were to try and drive down wage ratios, we would be favoring banks and financial services firms and technology firms ahead of retailers, where retailers employ unskilled, low-cost workers. And we'd be saying that financial services and IT, because they only employed high-skilled, high-paid workers, are in some way better for inequality than retailers. And that would surely be a perverse outcome in a South African context, where actually we should be saying we want to encourage the ShopRites and Pick n Pays and tourism and other sectors that employ relatively unskilled people. So how do we develop a metric that captures the right incentives to drive the right behavior for companies to want to deal with external inequality? I think in the global debate about this, it's critical that we get that right. And our one positive suggestion is that there is something to learn about BE frameworks that have a multi-dimensional perspective on what you're trying to achieve, that it has an external lens, and that might be a good way to assess companies internationally through a kind of multi-dimensional scorecard. I'll pause there and welcome any thoughts or questions.